More private credit concerns are creeping up. BlackRock now limiting withdrawals from one of its funds.
Private credit is experiencing its Roach Motel moment in terms of retail getting spooked. Retail is really worried. Retail's trying to take out more money than you're allowed to take out.
Headlines read, BlackRock refused investors from pulling billions out of their own fund. This news have investors scared and panicked because if the biggest asset manager on earth isn't allowing investors to take out their money, that means something is seriously wrong and it can have impact on the financial markets like stocks and crypto. So today, I'll debunk this news and I'll reveal how it's actually misleading you guys and not providing the true story. And most importantly, I will reveal how this news, BlackRock refusing investors to withdraw, isn't actually the concerning part. But why these investors want to withdraw is what we should be focused on and be concerned about. My job here is to explain the impact this news has on the crypto market because it already led to a 5 to 6% decrease in the price of BlackRock shares in the stock market. So here's the true story. On March 6, 2026, BlackRock, the world's largest asset manager with over $14 trillion in assets under management, announced it was limiting withdrawals. Not blocking or refusing, but limiting withdrawals from its $26 billion HPS lending fund, which is a private credit fund. Now, I'll explain afterwards what this fund actually does, what the private credit sector is, and why investors are trying to pull their money out. Investors requested to withdraw their money from this fund, but there was a pre-existing cap of 5% on these withdrawals, which means the fund can only allow withdrawals of up to 5% of the net asset value in a quarter. The remaining withdrawals are then delayed. This isn't some new rule. It was in the prospectus of the fund, and all of these investors who invested in the fund knew about this cap beforehand. The only thing new here is that throughout the creation of this fund, investors never tried withdrawing more than 5% in a quarter. This is the first time this threshold was reached. So, saying that BlackRock blocked or refused withdrawals is misleading here. The 5% cap was always there. It's just that the withdrawals never crossed the threshold before. So people may have forgotten about the cap. Investors wanted to withdraw approximately $1.2 billion from this fund, which is about 9.3% of the net asset value. This is almost double the 5% quarterly cap. So the fund paid out $620 million and delayed the remaining withdrawals. I think this is absolutely justified since these investors were aware of the cap and they agreed to it when they invested in this fund. Now that this part is clear, let's get to the actual concerning part. That is, why are all these investors trying to withdraw their money from this fund? Because this is the first time that BlackRock has received so many withdrawal requests from this fund that it actually broke past the 5% threshold. So something is definitely happening. The crazy thing here is this isn't an isolated event. This is part of a trend. Private credit funds from other firms are all receiving these massive withdrawal requests. Blackstone is another such firm where investors tried to withdraw more than their quarterly cap. But hats off to Blackstone, they actually raised the cap to 7% to accommodate these withdrawal requests by injecting $400 million from their own capital. Now, here's how the private credit works. Think of it like this. In the traditional world, a company might go to a bank for a loan. But with private credit, a fund managed by a firm like BlackRock and Blackstone pools money from investors and lend it directly to businesses, especially small to mid-sized ones that might not qualify for big bank loans because these borrowers are often highly leveraged, which means they already have a lot of debt. Now, these loans typically have a floating interest rate, which means it adjusts with market rates. Investors in private credit funds aim for higher yields, often 8 to 12% compared to safer options like government bonds in exchange for that risk. And this is the private credit. The companies that can't get a loan from bank, they get loan from this fund, and pays back with interest, which goes to the investors who invested in the fund. This industry exploded to about $1.8 to $2 trillion globally, largely because post-2008 financial crisis regulations made banks more cautious about risky lending. So they started refusing loans more often, which created a gap that these private lenders filled. Now let's get to the reason why these investors are suddenly rushing to get their money off these funds. And the factors here are the same ones that are impacting the crypto market. Lending money in private credit is risky because these borrowers are risky enough that banks won't grant them loans. So investors take the risk to lend them money in hopes of getting a higher return. So there's a higher chance that the loan doesn't get repaid or it gets reduced due to the borrower's financial situation. So you can think of a private credit fund as a risky investment. And you know what other asset type is considered a risky investment? Crypto, especially Bitcoin. Pulling investments from private credit funds means we are entering in a risk off market where investors are pulling out of risky investments. And when they do that, one of the first asset type that they sell is crypto because it's riskier, but luckily it's liquid. So they can pull themselves out without much problem. Now, the reason why this de-risking was triggered was because BlackRock recently zeroed out of a $25 million loan. They lent $25 million loan to an Amazon aggregator, but due to their financial situation, likely bankruptcy, BlackRock reduced the loan's book value to zero on their financial statements because they deemed it essentially worthless or unrecoverable, which meant a $25 million loss in BlackRock's books. This made investors anxious and they started requesting withdrawals. Moreover, we also have that geopolitical tension in Middle East, which is driving the oil prices higher and they are disrupting global trade, which always scare investors. But the most prominent factor here is artificial intelligence. A lot of software and tech companies are indebted through these funds, and due to artificial intelligence, their demand is decreasing and they aren't as profitable as they used to. So very soon they will go bankrupt and they won't be able to repay the loans. But this doesn't have any impact on the crypto market. So let's talk about the factor that does, which is the possibility of increased interest rates by the Feds. If the interest rate is increased, it becomes more difficult for borrowers to pay back the loan. And in crypto, if interest rate is increased, it lowers the overall liquidity in the market, which drains the prices. If investors suddenly start pulling their money out of these funds, those funds might be forced to sell their assets quickly just to pay back people. And when that kind of selling happens, it can reduce liquidity in the overall market and push investors into a risk-off mode where they avoid volatile assets like crypto. This can also create funding pressure inside the crypto ecosystem, including centralized exchanges and DeFi platforms. Now, another interesting connection is that some private credit has actually been tokenized on blockchains. And around $5 to $10 billion of these assets are currently being used as collateral in DeFi on platforms like Centrifuge and Realty. So, if traditional private credit funds starts facing losses or defaults, it could shake confidence in these blockchain versions and potentially trigger liquidations or reduce lending activity in DeFi. At the same time, all eyes are also on BlackRock, which is one of the biggest institutional players in crypto and manages the iShares Bitcoin Trust. If news like this causes BlackRock's stock to drop, it can affect overall market sentiment. But there is a tiny silver lining here. Some people might see crypto as a more liquid alternative compared to funds that restrict withdrawals, which could boost interest in Bitcoin and DeFi. But others might see it as a sign of broader financial stress, which could also lead to volatility across the crypto market. So that's my take on it. Let me know your thoughts in the comment section. And if you enjoyed this video, make sure that you give it a like. It really helps the algorithm. And I'll appreciate it if you can subscribe to the channel so you can watch more content like this. And I'll see you guys in the next video shortly. So stay tuned.